When military tensions escalate between the United States and Iran, the immediate concerns are obvious. We watch for troop movements, naval blockades, and the threat of missile strikes. But modern conflicts routinely bypass the battlefield. Long before a single shot is fired, the threat of violence sends economic shockwaves thousands of miles away, hitting the wallets of civilians who have no connection to the geopolitics of the Persian Gulf. As US-Iran tensions climbed, Prime Minister Narendra Modi issued a national directive. He asked his 1.4 billion citizens to completely stop buying gold for an entire year. This request reframed household jewelry purchases as a primary vulnerability to India's national security during a global crisis. To understand the logic behind that request, we have to look at how investors behave when they get scared. When global markets panic over a potential war, capital moves out of volatile stocks and into safe haven assets, physical, reliable commodities like gold. That massive, sudden rush of buying pressure acts like a vacuum, pulling the global price of gold sharply upward in a matter of days. While a price spike benefits those already holding the metal, it functions as an economic wrecking ball for nations that rely on importing it. India acts as a massive, insatiable destination for global gold consumption. The scale of its internal market is unique, creating a constant, localized pull on the world's supply. Gold functions as a bedrock financial tool across the country. It serves as the primary savings for rural families, generational wealth passed between mothers and daughters, and a mandatory pillar of millions of annual weddings. However, India has almost no actively producing gold mines of its own. Nearly every ounce required to satisfy this cultural demand must be imported from the international market. This reliance means an immovable cultural tradition transforms into a critical national liability the moment global prices are driven up by foreign wars. This chart shows a collision. A war-driven gold price spike meets inflexible Indian demand. Buyers pay a massive premium, draining foreign reserves like US dollars. Billions extra leave India for the same metal, ballooning the trade deficit, weakening the currency, and destabilizing the economy. The crisis is compounded by the fact that Middle Eastern conflicts also spike crude oil prices. India is forced to spend its dollar reserves on both essential energy and luxury metal simultaneously. Prime Minister Modi's plea functioned as an emergency macroeconomic circuit breaker. He attempted to artificially halt domestic demand because the government had no control over the global price. Changing the behavior of 1.4 billion people was the only immediate lever available to stop depleting national wealth and prevent economic collapse. During a geopolitical crisis, gold operates as a volatile macroeconomic weapon. The chain reaction is direct. A standoff in the Persian Gulf determines whether a middle-class family in Mumbai can afford a wedding necklace without damaging their country's currency. When the threat of war looms, tracking the stock market only provides half the story. The gold market reveals how import-dependent nations scramble to shield their economies from the financial blast radius of distant conflicts. In a hyper-interconnected global economy, total consumer discipline can provide a more effective shield against the fallout